What's going on, guys? Today I'm going to make a quick video discussing the put credit spread investment strategy. I know I've made one before previously a couple months ago, but I just wanted to make a new video just pretty much discussing some new rules that I like to apply and just a follow-up video on that. So if you're not familiar with the strategy, it is going to be involving two put options. In order to sell and buy options, you're going to have to get approved by your broker. Robinhood, I believe it's level 3 options trading for this one because margin is required for this type of strategy. But yeah, let's go ahead and jump into it. So SPY is a very popular ETF. It is the Spider S&P 500 ETF. And what I like about it so much is, number one, is the volume. Whenever you're trading options, a thing that I always, follow and make sure to account for is the amount of volume that stock or option may have. And why that's important, the ability to get in and out of options is very important. And, more liquid stocks and ETFs, the more likely you're going to be able to do that. So let's go ahead and jump into here. So this is on the Robinhood platform. So you'll go to whatever ticker or symbol you do, and you'll click Trade SPY Options. And this is, SPY is different because there's 3 expiration dates a week. But let's just go ahead and select Friday. And it's currently trading at 380. Let's actually go back and look at the chart. So the last week it's gone up $6. So it's been a pretty green week. So definitely be careful whenever. Always do your own investment advice or investment research before investing or trading options on an ETF. There definitely always needs to be more, evaluating ETFs and their charts just to see whether or not this could be a good opportunity to open this trade. But definitely do your own research as far as the fundamental analysis of different timings. And whenever you watch this video, this might be a different scenario whenever you watch it a couple months after I publish this video. So let's go back to the option chain here, and we're going to do the January 15th expiration date. So that pretty much means that all of these options expire on January 15th. So if you're not familiar with options, that's what that date pretty much means there. So we're going to be selling a put. So this is a popular strategy, just selling puts, selling a cash secured put. But the problem with that is, if I sold a 380 put, that's going to require $38,000 of collateral or capital that I'm going to have to tie up with this option. If you have that type of money, definitely option or selling cash secured puts are good. But if you don't have $38,000 and you don't want to use that much capital, spreads could be a good alternative. With spreads, though, you are capping your gain potential and you are capping your risk. So that's another thing to consider as well. So let's just go ahead and pick one deep in the money here. So we're at 381. And like I looked at the chart, it looked like it went up $6 this week. So let's just be a little conservative. Obviously SPY could drop $20 in a day. So, with this type of strategy, you're going to have to manage SPY and, watch it to make sure it doesn't have a big sell-off like we had in March of last year. But let's just pick something maybe like $15 out of the money. So, or $15 in the money, I'm sorry. So this would be in the money. This is out of the money. So let's go to around 365. Okay, so I'm pretty comfortable that, I don't believe SPY is going to drop more than $16. And this is pretty much saying that I don't believe that it's going to go below 364 before January 15th. And you can see this column here, it's a chance of profit. So 91% chance that this option is going to be profitable. But definitely do realize that that number can change very fast. So take that number, like if you see a 99%, don't think that that's always going to be the case, because it easily could drop to 60 or 70% if there's a down movement in SPY. So click on the options, you can see some more information here. It previously closed at 82. So if you would have sold it, I think Thursday right before close, it would have been $82. And if you would have held it all day Friday, you could have bought it back for $52 and you could have made $30 there. So another thing to consider is the volume and open interest. Definitely make sure this is at least, I like to at least do, 250 to 1,000. That's typically the lowest I like to go there. There's other people that recommend only doing 1,000, but definitely, because that pretty much what that is that's the amount of people that buy and hold this option. So yeah. So the delta is how much this contract is going to subtract per dollar move. So if it goes to 382, this is going to drop by $8. It'll drop to 44. The theta is pretty much how much it's going to decay each day that we get closer to expiration. So $14 per day. Okay, so in order to make this a spread, we're going to have to buy another leg. So we sold the put, so now we're going to be buying a put. So depending on how wide you want to make it, I recommend, a lot of people just do like a 1 point wide spread here, meaning your max risk is $100, and your total credit is $99. That's not right. Hold on. Gotta buy it. Yeah, so you're gonna make sure you buy. So this is a credit of 5. So it's a 5% gain on a $100 risk. So actually $95 risk, because you do the amount of collateral required, which is 100 minus 5, so it'd be 95. So you're making 5 on a $95 risk. But I've gotten to the point where I used to do these a lot, just 1 point spreads. But I kind of like to be a little bit more conservative here, so I make them a little wider. So this is going to cost more money. So if you don't have $500 at least in collateral, you're not going to be able to make this. But by doing this, you're making a wider, pretty much a wider spread. So your chance of probability increases, and you're not going to have to buy as many contracts, obviously, because it's a wider spread. So you could have bought five $1 spreads, or you could have just bought one $5 spread. I hope that makes sense. Sorry if I'm overcomplicating this, but that is the idea here. So you're making $18 on a $500 risk, or around 3.4% on 1,000 or 500, whatever. So it does decrease your ROR, your rate of return, but making wider spreads definitely makes your trades more profitable, and not more profitable, makes them the chance of probability higher. Just because, so the idea with this, if it's here and it blows past 364, so if SPY drops at 363, 363.53, if it drops below that, then you're going to lose your max. The most you're going to lose here, just go ahead and show you guys here. The most you're going to lose is you're going to lose that collateral. You'll keep the credit, so you'll get $5, but you'll be losing 95. So if it blows past that, you're losing $95. Like, that's just how this trade works. But if you make it a little bit wider, you have more of a runway here. So it could go to like 364. Do keep in mind though, if it breaks, you're definitely going to buy that back. If it breaks past this, someone else could exercise that option. So if it ever gets close to your spread, I like to close it out. It's not worth holding the additional risk, because pretty much what you're doing, you're selling this option. So someone else has the right to exercise it. If it goes past, typically they're not going to exercise it before it goes back past their break even. So, typically if it ever gets close to this guy, your break even here, I like to, close it or roll it out. Yeah, guys, so I would definitely recommend, at least if you don't want to close your spread before expiration, at least buy back your short position. So I sold this one, so I would buy it back. The reasoning for that, you may think you're fine, come Friday afternoon, say SPY's at 366.38, at 4 o'clock, it's that. But in the after hours, before 5:30, say it goes to 363, because options do run until 5:30 on Friday, or the day of expiration. So, if that happens, technically this option can get exercised. So whoever you sold this to could technically exercise this option, and that could be a very, very dangerous situation. I do remember there was a story a couple months ago. Someone was doing a debit spread, I think with Tesla, and one of his legs got exercised, late afternoon Friday. He wasn't even aware it got exercised. I don't even think his broker let him know that one of his legs got exercised. So it got exercised at this price, and then he never executed or never exercised the other leg. So come Monday morning, he pretty much found out that he was like, oh no, one of my options got exercised and this one didn't exercise. So his risk was a lot more than the spread here. It was like thousands and thousands of dollars. I want to say like $20,000 this guy lost. So definitely, if you take any advice from me, definitely close your spreads or at least close your short position before 5:30 on the day of expiration. It's just not worth that extra risk, guys, to make, because at this point it's going to be like pennies. I mean, maybe a little bit more, but it's just not going to be worth taking on that additional risk. So always close your spreads before expiration. That is my advice there. So that's pretty much it for this video. I hope this was clear and wasn't too concise. But if you have any questions, feel free to reach out to me. And as always, guys, make sure you know what you're doing before you start trading options. Options are more risky than buying individual stocks and ETFs. So always know your risk before entering any options trade. That's my biggest advice as well. Know your risk, know your reward. Optionsprofitcalculator.com, great website to use. If you're not 100% sure on the type of trading you're doing, you could see your max risk and max reward on their website there. And do remember, make sure this says put credit spread. That's another thing on Robinhood. But yeah, so always know your risk before entering any option. I mean, go to TD Ameritrade offers paper money. I'm always telling new beginners to check that out. Go on their platform. Just get used to how to do these trades before you go and use your real money. Because if you don't know what you're doing and you get into a situation where you halfway know, if you think your only risk is $500 here, but then, like I said, happened to that one guy a couple months ago with Tesla, one of his legs got exercised, so he lost over $20,000. So this is like some serious stuff to consider, guys. Don't make decisions if you're not fully educated and you know your risk. If you know your risk and you're understanding completely, then go ahead. You don't have to use the paper money account. But if you're a little unsure and you just want to get used to stuff before you start using your real money, I definitely recommend TD Ameritrade, their paper money trading platform. But yeah, I mean, that's pretty much it. I don't think I have anything else to say about this type of trade. I do plan on opening up a Discord channel in the near future, and pretty much just to have a community of my followers, just so we can talk and have more questions about stuff. And I am thinking about potentially offering some of my positions to other people. So yeah, that's pretty much it for this video, guys. Thanks for watching and have a great day.